right? This is, I put this program together from questions that I've been asked for the last 33 years. This is all I do. I'm a registered investment advisor. And when I'm here, I'm a yogi, but I do take my job very serious. It's a family-run practice. So thank you for joining us. And if you feel me, I'm talking, I have this live over Zoom. That's why it's our Zoom meeting. And we've got some participants chiming in. So when we open up for questions, I'll answer questions here as well as over the Zoom. So my name is Kevin McCarthy, and if you don't know who I am, my wife is Diana McCarthy. Diana and Olga own Body for Yoga. During the pandemic, Diana started doing chair yoga for my clients. And then we started doing this health, wealth, and happiness series. And so every Thursday, she does chair yoga for my clients through Zoom. I'm actually going to close that door. All right. So, again, we're going to be very casual and go through this, and hopefully you get some good content. Again, if you need help, I'm always looking to help somebody, but only if I can help. Because if you've heard of something, it's not broken, don't try to fix it. And that's right. So if you have something good, I'll pat you on the back and send you on your way. Again, it doesn't make sense for me to disrupt what you're trying to accomplish. But there's got to be a goal. There's got to be a plan. You just got to be religious to the plan. It's like working out. It's like a diet, right? If you get a good going, you don't have any cheat meals, and you're going to lose the weight. You're going to see the performance. Same thing with investing. It's patience. Okay. So it's going to be a little bit of everywhere, and we're going to go through some slides that'll help me get you where we're going, and we'll go from there. So first of all, as a broker-dealer, an independent registered investment advisor, my broker-dealer is Madison Avenue Securities. They oversee what I do. It's kind of like a second pair of eyes. So when I put on someone's application that they're conservative, and then we go ahead and buy Tesla stock, their flags go up and say, hey, you can't do that because Tesla would be an aggressive investment, whereas we said she was conservative or he was conservative. So they oversee what I do to make sure I'm doing right by you. I am a registered investment advisor, just clear through Madison Avenue Securities. So that's the relationship. When you see our statements, Madison Avenue Securities is a broker-dealer. I'm the registered investment advisor. So again, disclosure is all about who Madison is, the broker-dealer, and then me being the agent. So the basics of investing, know what to do with your money and know what people are doing with your money. You have to understand that if you have money in the bank, which you should, we'll get into the emergency fund, which is the most important bucket. But what does a bank do with your money? You know, they pay you minimal interest, but they're lending out on car loans or houses. You know, borrowing money today is relatively inexpensive. Maybe cars are a little bit more, the interest is a little higher because it's a little more risk for them because a car is a depreciating asset where housing is appreciated. So you have to understand what are people doing with your money. So just like investments, when you buy into a mutual fund, what are they doing with your money and what are the parameters? And we'll get into that when we get into to mutual funds and stuff like that. Because we're going to get into individual investments a little bit. And again, maybe today's will be like 1,000-foot view. We're not going to get so like there is no test at the end. But so we're going to get you know, your questions answered. But if you want to dial in, then we could dial in if we have time, or you know, set up a meeting. You know, to sit with me for 15 or 20 minutes just to ask your questions. I'll get them all answered. And again, you know, my business as a registered investment advisor, I'm a student of the stock market my whole life, and I have a good bearing of the tax code, and you know, attorneys write wills and trusts, and that's something you should recommend, because when you set up an account, how it's titled is so important to your planning, estate planning, and who gets the money and all that good jazz. And that's where, you know, the side of the lawyer comes in. I'm not a lawyer. I'm not a CPA. But if this is all I do, I just know those rules pretty well. Okay, so I only handle the investment side. You have to go to an attorney to get a trust. Only an attorney can put a trust together. And our fourth educational program is all about trust. And that's in about 6 weeks. This program is the second of our four summer series. The first one was halftime report of how the market did the first 6 months of the year and how it's looking for the next 6 months, which we like. We think it's good, pretty positive going forward from all our money managers and advisors going forward. So we do like the market. We just know that September, October are very volatile months historically, a lot of volatility, and you just got to be patient and ride it out. Or you can day trade, which I don't recommend. I'm not that type of advisor. I'm more overall planning. I interview for a job you did not even know it existed. It's called the rest of your life money. So I want to deal with the money that is going to carry you through retirement, and your kids will get whatever you don't spend. That's my type of client. That's who I work with. Now, again, I can't work with everybody, but I'll definitely get your questions answered. So I would never turn a question away. So getting into it, there's some terms here. And again, these investment terms, I'll briefly go through these. Again, there is no test at the end, but investments, again, when you invest money, it's a commitment of some form of time or risk exposure to that, and you need to know what you're getting yourself into. So realistically, how I explain a lot of my investments with my clients is, I'm going to put you in this box, and if this is the most you can make or the least you could lose, are you happy? Because it's all about exposure to risk. And if you're trying to double your money, I'm definitely not your guy, because I deal with more conservative, steady Eddie investments. But we could talk about Tesla, and we're going to talk about cryptocurrencies, which is high-flying stuff today. My broker dealer, and we don't even touch it. We don't do it. But again, I would say I would put maybe 1% of my client's net worth into it, just because what if it's right? But we'll get into that Ethereum and all that good stuff, because I do have some thought process there. Because Ethereum could challenge Amazon, which is Amazon. You're probably living a FANG life: Facebook, Amazon, Netflix, Google. That is your life for the last 10 years. It'll be your life for the next 10 years. Those four stocks have done probably averaging 15% the last 10 years, and they'll do it for the next 20 years. It's good stuff. So over here, risk, you need to know the parameters of risk. How much money could you lose? And that's, again, you don't put all your eggs in one basket. You heard that true. And it's true. Don't put all your eggs in one basket. And then passive and active. So passive is kind of like letting it ride, and which could be kind of scary. So we introduce people to passive management, and we also introduce people to active management, but not day trading. Day trading is too active, and statistically, a day trader, which at the end they don't end up making money. I'm not a day trader. I don't believe in it, and the story, the numbers on that is the stock they sold to buy did better than the one they bought historically. It's crazy, the report that we have on that. So going through these are just terms you just want to be knowing about. Now, direct investing, again, I'm independent, so there's not an investment I can't look at. I don't have, like, certain brokerage firms only recommend certain things, maybe house funds or their own funds. You go to the old days it was Dean Witter and Dean Witter mutual funds, or Merrill Lynch mutual funds. Merrill Lynch and Bank of America are teamed up now, and they'll recommend Merrill Lynch mutual funds. Well, again, there are a lot of double dipping in those because the fees are a little bit higher in those type of programs. So I like your Fidelities, your Schwab, those type of independent, cut the cost, and that's savings to you. So, and then indirect investment. So again, these are just type of words you should know when you're getting yourself into of who you're dealing with and who has your money. Because as an independent financial planner, I have clients that have insurance with different insurance companies, and then we have money in the brokerage firm, and that's totally separate, totally different. I'm using my life insurance license on some form of annuity or something, or life insurance. I have a life insurance license. So I have several licenses to be an independent financial planner. Okay. So next, stock market. I really look at it as the world's largest casino, but you're not going to go broke. There are certain companies that can go out of business, but if you diversify, okay, and again, always knowing what you're getting yourself into and getting education about it. It's just asking the questions, what's next? Same thing, you know, the old days in the brain behind it was Peter Lynch. He was the money manager at Fidelity, Magellan, and he would say, open your refrigerator. What do you have in there? You have Coca-Cola, great company. You know, just the products that you were using every single day. These companies are public, and that's some of the companies you should be looking at that you're supporting, and you should reap rewards. Like to me, Home Depot. You know, who doesn't go to Home Depot or Lowe's? Home Depot is a public company, pays a dividend, so kind of good stuff there. So we'll get into a little bit more of that. So why should you invest? Now you don't have all the slides, by the way, so you just have the ones that I can take on with you for notes. So why should you invest? First goal is retirement plan. Okay, Social Security is try not to rely on it, because if you're under 40 years old, it may not be there. There's a challenge with Social Security. I know there's a challenge with it. I don't know how to fix it. So when Social Security was created, there was like 7 or 8 retirees. I'm sorry, 7 to 8 people working for every 1 retiree. Today, it's 3 people working for every 1 retiree, adding into it. Now, they've already said that Social Security will run out of money, and they have this, it's a moving target. And it, 2033, 2034, 2031, it keeps moving. And this next year, people on Social Security are getting the biggest increase I've ever seen in my lifetime. It's over a 5% inflation increase, which is huge for them. But it's also deducting from the pool of money. So something's got to give on that. But not only Social Security is the challenge, healthcare is the other challenge. So you have to fund these things through your retirement. In the old days, you worked for a company for 20, 35 years, and you got a watch and you got a pension. There's no Rolex watches anymore, and there's no more pensions unless you're Florida retirement system, which maybe you're a nurse or a teacher, a police officer, fireman. Those have very good pension plans. They give pensions for time served kind of thing, right? So you put in the time, and they reward you with a nice pension check for the rest of your life. I got some retired teachers that did super well, and they've done extremely well with those type of retirement plans. Florida retirement being one of them. Very familiar with the FRS plan. They have the investment side and the pension side. I like the pension side. I don't make any money investing, recommending the pension side, but who else can guarantee you a monthly check for the rest of your life? So those type of plans, especially looking for a job, and that is one benefit that's going to be there forever. So we like that. So the only one I know now for a pension, private companies don't offer you a pension. They don't offer it anymore. So it's up to you to put away for yourself. You need to, every self-help book says pay yourself first, but not a lot of people do it. And so when you get your paycheck, who are you paying? You're paying your bills. So a lot of the way to be most honest about it is go through your checkbook, log into your checking account, and go over the last 6 months. You're going to tell me what you want, what you love. But if you tell me what you're spending your money on, I'll tell you what you want and what you love. You're going to realize what some of the investments, not investments, some of your expenses that you're using are not necessary. And it goes back to need and want. And I a great argument with my wife, Diana, it's a need or want. What do we need it? Do we want it? She wants a lot. She's very wanting. Right? She's very wanting. So, again, why you should be investing. It's for yourself. Who are you thinking about? You. Now, what can you invest in? All right. Real quick, real briefly. Money markets, the bank. The bank is a great temporary parking spot for money because it's low interest, it's completely liquid, and it's just waiting for you to make the right decision to move it into the right investment when you find the right investment. Okay. So we use money markets a lot just for a short-term vehicle. It's not a long-term investment. Don't keep a lot of money in the bank. We will talk about that for your emergency money when we get there. Fixed income, bonds and asset-backed. Now a bond is an investment in a company, but you're buying you're creating their debt. So they owe you. It's an IOU. You buy their bond and they guarantee it, they guarantee, but they're gonna say they're gonna pay you a set interest rate until the end of the term, and they're gonna return the principal. So you're lending money to a company. You have no equity in that company. It's a note, it's a commitment from them to you. That is a bond. Now, a stock is an equity. You're buying shares of a company. And most companies are public. There are very few that are private. But your Home Depots and your Coca-Cola, those are
private too.
Publix actually public, but only to employees. One of the best investments. They've done very well with their stock. I do have several Publix employees, but you can't buy and sell. It's not openly traded. I can't buy it personally unless I go to work there. So Publix is a public company, but they keep it to their own employees. Kind of private, public, right? So, but you can get the price of the shares every day. Life insurance. We're going to talk about this a little bit. Term and rest of your life money, universal. Life insurance is a key element when thinking of financial planning, because you have to be here to fund that plan. But if you're not, who are you leaving, short? Because if you're newly married and you have a mortgage, with one of you are no longer there, that could be detrimental to leaving somebody behind. So we're going to talk about that, and then we'll get into cryptocurrencies. We'll have fun with that. Diversification. Now diversification, again, how I say, don't put all your eggs in one basket. It's pretty key, but you have to understand diversification also comes with some downfalls, because if you look at if you're going to be this one's going to be up while this one's down, and it's kind of leveling you off. When you're diversifying, sometimes it gives you some averages, and when you do averages, you're dividing, and when you're doing dividing, you're lowering your returns. So I'm not saying you should. There's such thing as too much diversification. Like right now, there's 3,500 stocks. You wouldn't want one share of every public company because some of them are not going to perform well. You want to stick with your winners, and like cryptocurrencies, you've got over 2,000 cryptocurrencies right now.
And it takes even more.
And so you got some good. All right, so but you only hear about the winners, right? But yesterday there was some that were down 90%. Those are losers. That's not good. So we'll cover that. All right. So starting point. So the starting point with investing, it's your most important bucket of money is your emergency bucket. So your emergency bucket should be, again, it's a comfortability thing here. It's going to be take your income and you're going to divide between 3 to 6 months of living expenses. Especially living in South Florida, we live in a hurricane central, area. If you had to get out of Dodge and you were closed, COVID should have tested this, where you have assets or availability funds that are liquid. If you had to get out of Dodge for a hurricane, here that money is completely liquid and available. So it's a comfortability. I've got clients that use a year income, that is in the bank, not earning anything. But emergency money is exactly what it's for, emergencies. It's not to buy your next stock or Home Depot or cryptocurrency or life insurance or anything of that nature. It's for emergencies. Now, the best way to cover your emergency fund, did I go? Oh, okay, I'm ahead of you there. All right, so starting point. So your most important is I went too deep on the emergency fund, but I'll go back. So emergency fund is your now money. That's your most important bucket. The next is life insurance. It depends on where you're at. Now, if you're single and you don't have anybody, then you may not need life insurance. But I will show you a way to overfund life insurance when I get there. That could be very beneficial. The next in line is funding a company's 401k that has matching. If your company is matching, that's free money. You cannot beat free money. Okay, so you should be up to 100% of whatever they're matching. You should be up to that number. Okay, if not more, but not less, because you're leaving money on the table. So if a company is matching, you need to be in that plan for that free money. I can't beat free money. Your next one, and I'm a big believer, is a Roth IRA. A Roth IRA is putting after-tax money you already paid tax, into a retirement plan. And you get to take it out after 5 years or 59 and a half, totally tax-free. Doesn't even go on your tax return. Fantastic. Okay. Now, I'm going to differentiate between the two. There is such thing as a Roth 401k, which I do like. Now, the 401k is before tax month. So you're saying, you're kicking the can down the road. You're saying, I'll pay taxes on you later. I don't know what it's going to be. I don't know what my income's going to be, but I'll settle up with you later. Uncle Sam likes that. Most of my clients don't. That they've already done that. Now, on the Roth, it's after tax. You've already paid today's tax bracket on that money. Now, there is a limit that you can contribute up to, when the IRS puts you on a limit, it's usually a good thing. Now, right now, the maximum is $6,000 per year. That's the most you can put into contribute to a Roth IRA. There is unlimited conversions, and I would look at converting your traditional retirement money to Roth to pay the taxes, because you know where the tax brackets are today. You don't know what they're going to be in the future. Now, if you put a guess on it, where we're at as a country in a debt scenario, we owe a lot of money, and we are responsible for that eventually. So I think taxes will increase. We did have a sunset with Trump in office. There was a 3% discount. That went away when he went out of office. So this year you're paying 3% more than you did last year, regardless across the table. And Biden, again, what he comes through, I think taxes are going to go higher in the future. But I still would recommend looking at the mathematics on a Roth conversion or Roth IRA contributions. Last on the line is your investment account. This is more fluid money, more shorter term. Retirement plans, you can't touch them until you're 59 and a half. And you have to touch them on the traditional at 72. The required minimum distribution comes into play. So investment accounts are maybe you put out a plan that you're going to purchase your first house or maybe your first income property, maybe 4 to 6 to 8 years down the road. You start accumulating assets and you're using the market because you worked hard for the money. Now you put in a good investment with the stock market. The market's going to accumulate and maybe pay some dividends, and that's going to accumulate for yourself. So you only pay capital gains on that. Long-term capital gains is only 15% right now. So again, the taxes, you do have to share your money. And I'll go back to your traditional IRA. You have an IRA, it's not all your money. And it's how fast you take it out is how much you pay Uncle Sam. You're going to have a tax bracket. Now, if you have a pension or your income or Social Security when you're retired, half of your Social Security goes against your tax bracket. And any other income goes into that. And your withdrawals from your IRA are taxed at ordinary taxes, no capital gains. So it's not 15%, it's your tax bracket, which again, is right now 24, 28 and higher. So you just got to know your tax bracket. Depends on how much income you're bringing in that year. Question?
I just have a quick question about the Roth IRA. If you defer to pay taxes later, knowing that you probably won't make as much money as you make now, right? Isn't there some logic in waiting to pay the taxes when you're older on a smaller tax bracket?
Yeah, I mean, listen, if you know you're not going to have the income later on, then Roth may not make sense. But it's all a mathematical equation. And you know where the bracket is today. Are you happy with, let's say you're at 25%. Are you happy with that? Because you're gambling later on, not only what tax brackets, but what your income will be compared to the tax brackets. And again, the one thing that I don't like, and it's called the widow's penalty. Married couples, all their lives married, but filing taxes, and all of a sudden one passes away. The widow penalty is they're in a higher tax bracket now.
What?
Yeah, an individual has higher tax brackets than a joint. So again, we call it the widow's penalty. It's not great news. My clients, they've been in a certain bracket their whole life, and all of a sudden one's no longer here, and they have the same income or maybe a little bit lower. boom, she's in a higher tax bracket, he's in a higher tax bracket. It's not great news. So that's why I like the Roth, because it'll eliminate that challenge. That money is never, it's not even on the tax bracket. So let's kind of go in this. I kind of already went through the emergency fund. Again, I think this is your most important bucket of money, because if you have this, you won't disrupt your investments when it's necessary. So if you spend your emergency money on an emergency, you can always be patient and replenish it later on. That's why when I say, like, when you need money, you go to the market, it may not be the right time. So that's, I think, the most important bucket of money. My next would be life insurance. Again, life insurance, there's two types. Well, there's a lot more than two types, but the two main types. Term is temporary. Like when I got married, I was instant family, and I had responsibilities, and I ran out and got some term insurance because I just knew that if something happened to me, I didn't want to leave a mortgage, and I wanted to ensure someone goes to college, and I told my wife, marry for money next time. So that kind of thing. So term usually replace the word with temporary. Term insurance is temporary insurance. Less than 1% of term insurance ever gets paid out. 90% gets converted, and the other 9% just goes away. So term insurance, temporary. Now I'll introduce you to universal life, and I like overfunding life insurance. Now you would say, why would you pay more? Well, the insurance company will tell you the minimum you have to pay into your life insurance policy. You know who tells you the maximum? The government. And what did I say earlier? When the government's telling you, hey, you can't put too much into that one investment, it's usually a good thing. Because you could, if you stay right under that limit that Uncle Sam tells you can't put more in, stay right at that level. Okay? If you keep doing that, that money can grow tax deferred, and eventually you can take that money out tax-free through policy loans. That's very attractive. It's overfunding life insurance. You got it. IO started. Have a good class.
Thank you.
All right. So again, government sets the maximum on that, and there's definitely a lot of benefits, because what we're doing is we're trying to buy as much, the least amount of life insurance with the most amount of cash accumulation, because we're thinking about not dying. So are we at, okay, we're good, friends. All right, so Wall Street, Main Street, this is just really where you're getting your information from. And, I like to share a couple quotes from Warren Buffett, and I'll have in the next couple page here. But I also have Denzel Washington. He says, if you're, I have it here. I'm going to mess it up. Oh, wow. All right. If you read the newspaper, you're uninformed. If you don't read the newspaper, you're uninformed. But if you read it, you're misinformed. But if you actually search that quote, because there's actually extent of the quote. But what I want to share with you is, you got to worry about where you're getting your information from. Now, you may have your favorite news station, but think about how the news is coming to you. Aren't they excited to get the most recent news to you, how fast, and maybe not getting both sides of the story sometimes? So it can be very misleading. So again, when we get into some other investments, it depends on who you're getting your information from. I mean, TikTok should not be your reliable source. Though they have some good things my wife shares on her wine talks and stuff like that, but not investment advice. All right. So then again, these about diversification. Here we go, asset classes. Again, this is just, bird's eye view, and where you think, some of these are cyclical, okay, and some of these are more consistent. And this is talking about diversification. And then not only asset class, the next page, it's sectors. So you've got all these moving parts, and you have to figure out how to invest. Well, we let the professionals do that for us. And again, 80% of money managers don't meet or beat the S&P 500. So why wouldn't you just be the S&P 500? Or go to the 20% that beat the S&P 500 consistently. That's all you have to do. It's a mathematical equation. Look at past performance. Doesn't guarantee future performance, But if they're consistent, they're gonna be pretty consistent with that. And then you also have to look at fees. So this was, not this year, but last year, Tesla stock was up 700%. I'd like to be accumulating that stock, but Tesla's a very risky stock. But everyone talks about the winners, but no one talks about the losers. Now, you know, Air Canada is one of them, down 50%. I don't think Air Canada is going out of business. It's just COVID, right? Carnival Cruise Lines is up there, right? Challenging times. No one's taking cruise. They have no revenue. The stock went in the toilet. Eventually, they will come back. I think, you know, I dream that we'll go back to normal someday, right? So, but it is high risk in individual investments. So I don't do a lot of individual issues for my clients. So this is where 80% of money managers underperform the S&P 500, and the average stock market return is about 10%. Okay, Warren Buffett, again, he's got a couple rules of investing. Again, you don't mix politics with your investing, but he likes, you know, don't lose money. And rule number 2 is go to rule number 1, right? Don't lose money. He just is against, you know, he's consistent. And the guy's a billionaire for a reason. One of his main holders is Coca-Cola, dividend paying stock and consistency. You know, everyone looks at the bigger. So the stock market goes up and down, but how often does it go up and how often does it go down? Well, it's daily. But a bull market, the average bull market is 3.8 years. Bull market is when the market's going up. It doesn't go straight up for 3.8 years. It's this jagged climb. Okay, news. You know, things happen. You know, we live in an economy, or you know, just news comes out and the market's going to be down that day. That means there's more sellers than buyers that day. It's temporary. The market is a mathematical equation. Now, the average bear market is less than 10 months. So if you got in the stock market at an all-time high, which it is today, and it started to correct, so you just got to be consistent. So when you're with a plan, just like your health plans and just like your workout, be disciplined to it. Get to the class and be paying yourself first and being consistent investing in your plan. All right, red flags. I like this because everybody is always selling something. I'm selling something. I'm selling a relationship. It's not for everybody. But if you listen to people on like Jim Cramer, he's got a big mouth on TV. You know, he's getting followers. And his advertising dollars are paid because how many followers he has. So Dave Ramsey. I think Dave Ramsey is fantastic for getting people out of debt, but his financial advice, his investment advice is not really not good. Susie Orman, another talking head. Susie Orman's been around a long time. You know, she doesn't listen to her own advice. Isn't that funny? You know, she's not listening. She's not taking her own advice. Well, I take my own advice. So you'll be investing right alongside with me, or you're working with me. So just be careful. You know, there's always somebody selling something. If you know what you're getting yourself into, what's going to cost you, then that's the most important part of it. No one has a crystal ball. And with the stock market, it's a timing thing, and you want to be patient, and you want to be rewarded. And I think you're going to be rewarded for being patient. So really, you need to kind of tune out the news, turn off the TV. I think that there's just too much going on there. So if you're timing the market, and if you miss the 10 best days, your return cuts in half. That's huge, okay? Because if the average stock market returns 10%, and you're trying to time it, you're missing the best 10 days, your return's going to be 5%. Well, that may not be enough to get to your retirement. Early years, you need to be building up money at a good, that mid-teen rate of return. All right, how are we doing for time?
6:05.
Say it again?
6:05.
Okay, all right, so investing apps in today's economy, today's marketplace, technology has brought the stock market to your phone. And apps like Robinhood and Stash, you could buy stocks or mutual funds and accumulate. I mean, Robinhood has Roundup. I think this is fantastic. When you swipe your credit card and they'll throw money into your mutual fund for your account for you, it's forced savings. We're not good savers, and they were going to force you to save. That's fantastic. I wish I had that when I was a kid. And, just younger, you save so much money. I have so many tricks. My wife, it's the thing I do with single dollars. I don't break dollars. I don't break change. Like if I have change in my pocket, I don't break it. And I have a whole coffee can because that's what we used to do, and it's all full of change. And now we do it with singles. So I don't give singles to a cashier. I'll break a 5 or 10, get more singles, and I keep accumulating singles. And I just let my wife go to the bank and cash it. It's my funny joke, but it's a way it's forced savings. Robinhood, swipe Roundup, I think it's a fantastic forced savings. Stash, they let you buy individual stocks. You can go on there. You could have bought Tesla last year for $5. You don't have to buy a full share. They do partial shares. Berkshire Hathaway. Now this Warren Buffett's company is called Berkshire Hathaway. His company has never split. So a share of his stock is, I believe, $420,000 per share.
Wow.
You have to have one share to go to his annual shareholder meeting. I had a client that used to get dressed up and go every year. Guy never seen him in a suit. He would put on a suit, go to Oklahoma for that shareholder meeting. He's done very well for himself. But now with these type of apps, you could buy shares of any company out there that they list. So I think it's a forced savings, and it's early on. You're getting the education of how it works, buying and selling. Fundrise, that's a real estate investment trust fund. Prosper is a lending money, peer-to-peer. Fidelity, E-Trade, those are discount brokerage firms. And we'll get into Uphold and Kraken, which is 10 other crypto ones that I looked at, but we'll talk about that. So let's get into cryptocurrencies. Now, I'm going to be very light on this subject. I'm going to tell you what it is and how it's changing, because everything changes. My mentor, who got into my business very late, he used to sell encyclopedias door to door. Now, if you don't know what an encyclopedia is, it's a book of knowledge that he used to, again, the whole library of them. And again, with Google really put them out of business, right?
Google took over.
So you could just Google anything now. But what I'm saying is things change. Tesla has changed the car market. They don't negotiate the price, and you order it online, and most of it's done online. They do have stores now, but you just go and you buy it online and you pick it up when it's ready. It's crazy how everything is changing, and I think for the better. I can't stand negotiating for a car. So cryptocurrencies, be careful with this one here. So I'll give you two people. Let's see. Kathy Wood, now if you don't know Kathy Woods, she runs ARK funds. Now huge in the crypto market, and has come out and says, listen, there's 2,000 of these cryptocurrencies, only 3 or 4 are going to survive. That's high risk, high venture. So only put money in you could afford to lose. Now, my nephew recently, Elon Musk was going to be on Saturday Night Live, and Dogecoin, however you say it, is going to go to the moon. It was like 60, 70 cents at the time. And I told him, I said, listen, only put in when you could afford to lose. And I recently saw him the other day, and I said, hey, didn't work out short term, but you got to love it because it's no longer 60 cents. It's 25 cents today. If you liked it at 60, you got to love it at 25 because you can buy it's on discount. He didn't think that way. So it's the way you remember, if you have a plan getting in, what's your exit strategy? It should be. So again, I don't really, my brokerage account, we don't allow this, but I do think the way Ethereum is, they could challenge Amazon, and Amazon has built this platform, and I'm sure everyone out here has bought something through Amazon.
They're a monopoly.
So they're a monopoly.
Yeah,
so whether they get broken up for something to challenge, this could be a challenging. So cryptocurrencies is a way to almost like a cash out. that's how I explained it to my mom, which I explained sell to her too. But it's peer-to-peer. There's no middleman. So, and the transactions are really private. So that's why the government now, and they're coming down there, they want to know how to tax it. How could they make money with it, and how could they kind of guide it? And that's the challenge, because this peer-to-peer market, and that's what everyone loved about it. First, it was, hey, it's where the dark money is, or the bad money is, where they could exchange go. So not a lot of that has been cleaned up, but the regulators want to get involved. I think there's high risk, high adventure here. I wouldn't put a lot of hard-earned money into it, but I would put maybe, money I'm willing to risk, or willing to lose. Okay, say goodbye to it. But if you bought it and you put it away, and again, people are trading it because it trades daily. I don't know how they do that, but long term, a couple of them could rise, like Wood said, and that's something that could be astronomical into the future. So again, I do like how they're creating new things, and the banks are kind of upset with it. But if we could, share money, in the blink of an eye through my phone to your phone and an app, and it's safe, and you're getting what you were promised, and I'm getting what I was promised, and we're happy. So it's a little touch there. Real quick, interest rates. Historical low interest rates on borrowing money. It's fantastic. Now, when I started my business, retirees would put their money in the bank and they would get a 5 or 6 or 7% interest rate at the bank, and that's all they would live on. That's all they had to do. But now the bank's not giving them 5%, they're giving them 1%. So it's a great time. It's not a great time to give money to the bank, but it's a great time to borrow money from the bank. I mean, interest rates, historical lows, if you get yourself. So the question here is, there's one book out there, Rich Dad, Poor Dad. And I told my kids, I'm the poor dad. But you got to think. So with interest rates being so low, and a house that has gone up in price, and you're like, well, I can't afford it. You got to think differently. How can you afford it? What would it take to get into that house? Because you're borrowing at such low interest rates, and a lot of that payment's going to your principal, and that's going to accumulate wealth faster than ever. So again, it's too expensive. It's how do I pay for it? And that's a different methodology or thinking process of getting into your first house or your rental product. So it's not at the 5-bedroom. That's definitely not your first house, right? Hopefully not. But it's not the bedrooms, it's the doors. Anybody coming in and looking for a house, why not start out with a duplex and have someone else pay half your mortgage? And that's real estate. I think is a fantastic. Now I don't do real estate, but I think it's a fantastic investment. So think of more doors than rooms. And let's see. All right, expectation, reality. We wish it went like that. It doesn't. There's going to be bumps in the road, and there's going to be tough discussions. I tell my clients all the time, yeah, the market's up, and we're doing good, but we're going to have a tough discussion one day. We're going to talk about what the market did to us and how we protected ourselves and what guardrails we have in place. So my clients, if we talk about the rest of their life money, again, not 100% is in the stock market. So we have more conservative programs that have guardrails that they share in market gains and not in the losses. So again, when we're talking the rest of your life money, you diversify properly and you protect yourself. All right, conclusion. Conclusion here is really interview advisors. When you go to talk with an attorney about a trust, interview different attorneys because they have, they'll give you an hour of their time, ask them questions, and you may take questions that you got from that guy to the next guy. Just interview around. It's an investment in time. So I've shared this with my wife a lot. She'll spend more time planning a vacation than planning our retirement because she just leaves it all up to me. But when she's dialed in on a vacation, she's getting things to do when we're there, travel, the car, the flight, the hotel. She's dialed everything in. And she spent a lot of time getting the best price and the best vacation whether that 3-day mini vacation or 7 days or 9 days, she's invested hours and hours in that. Why would you invest hours and hours for the rest of your life money? So make it part of your plan. Once a month, once a quarter, you need to be reviewing your accounts and where your money's going. Go back the last 3-6 months of your checking account, see where you're spending your money. How much are you spending, how much are you investing for you, and how much are you spending on a need, and how much are you spending on a want?
I use that list for a while.
So on the, what I'm saying is, successful investing is hard, okay? But you can get help. You just gotta ask questions and work with somebody that's gonna listen to you. So there's 3 things that I tell everybody. You need to like them. You need to think they know what they're talking about. And you feel down the line, you feel you could give that person some trust. If you can answer those 3 yeses, again, like is easy. I think it's easy. Knowing what they're talking about, somebody experienced, they've done it, they're giving you the ins and outs, and you can give them the trust that, earn trust down the line. Those 2 things, then you'll have a successful relationship. And again, you may be working with somebody, and if you come to me and I'm like, hey, it's not broken, don't try to fix it. I can't help everybody. There are people I can't help, and there's people I cannot. I don't want to help, if you believe it or not. Because it's got to be a good fit for you, it's got to be good fit for me. And I'll introduce you to my team here. Diana does work in my office 1 day a week. On Thursday, she's not in the studio. But every day, Monday through Thursday, not every day, Monday through, her sister, Vivian, is my right arm. She does all my new relationships, all new clients go through Vivian. And her daughter-in-law, Stephanie, then next to her, she runs all my marketing. She put together this program. Thank you, Stephanie. Next slide. All right, so like I said, investing is hard. It's all about control. You can control your risk, okay? You can control the cost. You control the time, all the behavior. We can manage all that, but we can't control the return. But that's what everyone looks at, is the return. What did you do? What have you done for me lately? But if you're well diversified in a portfolio, I could capture that. I get those returns. Now, anybody have any questions, burning questions in their? Got a question? Let's hear that.
So you advise and you actually manage the investment?
I manage the money managers.
So you do manage our investments?
Yes. Yes. That's it? That was the only question?
Yes.
All right. Any other questions? Stephanie, any questions on the Zoom meeting?
Yes. Vanessa wants to know, do you recommend using Robinhood for stock market investment or just stick to Roth IRA and other methods of investment savings?
Well, it's a conflicting question because she says Robinhood, which is an investment app, and then Roth. Roth is a type of account. You can open a Roth IRA on your Robinhood account. And if you open it, I mean, the minimum is $5 to get started. The earlier you start, money only needs time to grow. The earlier you start, the better. So that's it. The question is a little conflict. I like the Roth IRA, but you can do the Roth IRA with Robinhood. Do I recommend Robinhood? Again, for somebody starting out, I think it's a fantastic place to start because it's low minimums. What else?
What about Acorns?
Same thing. Acorns.
I started that February just when my kids could learn.
Yeah, I think it's a fantastic. I think it's a great training, teaching. There's definitely a teaching moment there. Definitely.
Okay. What are bulls and bears?
Bull market.
Bulls and bears.
Okay, bull market, average 3.8 years from the slide. Bull market is when the stock market is going up. Bear market is when the market's going down. So we like the bulls because that's going up. That's good news. Bear market, we don't like.
Okay. Jennifer wants to know, what do I do with a 401k retirement account from an old employer?
Oh, okay. Great question. Old employer money, 401k. If you're no longer working there, they're no longer matching. So roll it over to an individual IRA. That gives you a lot more flexibility, a lot more options for your investing. Because at the 401k, you're only gonna have maybe 35 different mutual funds to choose from. But if you roll it over, now you have the whole world as your oyster to how to invest. So better options and less fees. What else?
Okay, question from Gwen. What is the best way to receive a lump sum payment of your pension while paying the least amount of taxes?
Okay, lump sum pay. All right, so there are, like Florida retirement system, you could opt to take all your pension in lump sum. But then again, if you take it all, Uncle Sam says, thank you, we're gonna share, they're gonna get a bigger piece of that pie. My recommendation is don't do it, but it depends on what you're trying to accomplish. Maybe you could spread it out over a couple of years. Again, if it depends on how big the pile of money is, and if you take it all in one calendar year, it's gonna be all taxable in a brand new tax rate, and that tax rate's gonna go for all your income, not only the rollover or it wouldn't be a rollover, sorry, it would be the acceptance of a pension funds. Pension funds are never taxed money. So let's say it was $500,000. That means your income that year is $500,000.
So your tax bracket goes up.
It'd be the highest tax bracket, given 38% to Uncle Sam. Not the way to do it, unless you had some health thing or something. I don't know. I don't see why that would ever be a good reason. I would always look to take. Now, we have been able to beat pension payout plans through going through another. We shop around. I'm independent, so we shop around and get who's going to give us the best payout for a set amount of money. So we have been able to roll it over, but that rollover is tax deferred. IRA to IRA, no tax consequences until you touch. You only pay taxes when you touch the money. You're allowed to roll over. You're allowed to do one rollover for every 365 days. You're allowed to do 365 direct transfers 365 times a year. So you're able to move money from IRA to IRA without tax consequences. Any other questions?
I have one more.
Yeah.
From Emmanuel, where do I start and what is the minimum?
Okay. All right. Where do you start? I think you start with an interview. Interview 3, 4, 1. I just interview a financial representative. They'll have them at the bank again, but they're going to be captured and they're going to be limited to what they can help you with. I would definitely interview somebody at a big brokerage firm and interview a independent financial advisor. They all offer different things. They're going to be in different places in their careers. I'm in a place where my career, I'm very happy with what I do. I enjoy going to work. My job is so easy. All I have to do is manage my clients' expectations. So the minimum, there is no minimum. Look at $5 on one of those apps. And if you find somebody that has the app and they refer you, you get 5 and they get 5 or something like that, right? So I think it's a win-win situation to get started.
Well, I think you said it's very similar to working out. It's just being disciplined and like sticking to your plan of being healthy, being better financially.
So we put together this health, wealth, and happiness series. My wife does the chair yoga on Thursdays for my clients at 10 a.m. in my office. I do these educational events. We think that keeping people up to date with what's out there. This one was kind of like starting from scratch. Next in 3 weeks, September 1st, we have one that covers just taxes. And then 3 weeks after that, we have one that's covering trust. Again, I'm not an attorney and I'm not an accountant, but these are the topics we're covering because taxes can be very critical to your plan and what you're trying to plan for. So you don't want, again, diversification. You don't want to put all your eggs in the retirement deferred bucket. You want options. You want money in the bank, in investments, you're only paying capital gains, and then you want the Roth IRA bucket, definitely, because that's tax-free. So later on in life, you have choices. If you need to go, you needed $40,000, $50,000 to go buy a car, and if interest rates were too high, because right now borrowing money would be cheap, definitely borrow cheap money. But if you need to get your hands on money, you don't only have one bucket to choose from, you have several, tax-free, taxable, and tax-deferred. So you're not depleting one account, you take a little bit from everywhere. So again, diversify your investments and your options. So again, 3 weeks, September 1st, I have a Zoom meeting on the taxes program. And my wife does the yoga every Thursday, keep going there and stuff. And we do Zoom bingo for our clients once a month. We do some social events because we love dealing with our clients. So we do Zoom bingo. We started this again with the pandemic, but we continue. We're having fun with it. And there's prizes, gift cards, Amazon or Publix we give out. We also do, book club. You guys are familiar with your book club here at Body of Yoga? We have one at our office. It's the same exact book. So just let you know that. And last, I talked about the tax program. That's September 1st, 5:30. If you want to be invited, if we grab your email, we'll throw you on our mailing list. We mail out 2 market updates every week. We do some social events. We do the social media. Stephanie handles all that. But we try to give good content and keep it light. So, any other questions?
One question, you mentioned, I can't recall the name, give some information, but whenever you have like the Roth IRA, is that Roth IRA, can people use it for investment purposes, that Roth IRA?
Roth IRA is the type of account.
Okay.
How it's invested, that's how you choose. You could buy a Home Depot stock, you could buy an annuity, you could buy a mutual fund, you could put in a managed money account. That's just the title of the account. We know it's after tax money, and we know it's going to grow tax free because it's categorized under the Roth.
So any capital gains just stay there?
It accumulates tax free. You don't have to, there's no capital gains in a Roth IRA. You take it out, you don't have to report it on the same, it's all yours.
I have too many questions.
Go ahead.
Also, when you're talking about diversification, I've also heard that they also consider like investing like hard coins like gold, platinum, or silver. What are your thoughts on that?
Again, the hedging up on that one, I don't like personally. And again, it's higher risk in the coins. So I've always stayed away from it. Now, there are big believers in it. Again, there's gonna be an opinion there.
Yeah,
right?
Rich dad, poor dad has like a very advocate fact, so like,
Yeah.
I've heard of it, but I haven't really done anything with that, but
I think there's better ways to hedge against that. Yeah, one more question.
yeah, dollar cost averaging.
Yes. All right, fantastic, great question. Dollar cost average, what is it? All right, so you're not like, so you're let's say you're buying something every month on the 15th of the month, you're gonna buy Home Depot stock. And today it's $200 and you buy 1 share and you pay $200, you got 1 share. And next month you put in 200, but the stock price is $230. So you're only putting 200, so you're not getting that full share. And then the next month you put in 200, but that stock price dropped and went to 180. So now you have these 3 partial shares and you divide the cost. So dollar cost averaging is fantastic for accumulation because you're not timing the market, you're being disciplined to the plan of buying in at a certain day, at a certain time, a certain amount of money, and just being consistent with it. And you will give yourself a good dollar cost average. Because at the end, when you're done averaging your cost, you do the math, your cost will be lower than the stock price. That's the goal. So I like dollar cost averaging on accumulation. It usually does not work on the exit, on income coming out.
And I guess when you're talking about investments, there's like ETFs and index funds.
Yep.
Which one, like, would you recommend this?
They're pretty much the close thing. So you have several options there. You know, individual stocks, a mutual fund is a combination of, again, they're buying a pool of stocks. So we like that, and ETFs are the same exact thing. Now, there are mutual funds that have limited shares, and there are mutual funds that have unlimited shares. Okay, I like limited because it helps on the stock price. ETFs, I definitely like ETFs, how they were built, and those are just mutual funds on steroids, really. But then again, it's what exposure. Then you have to go back to your sectors. You have to go back to diversification. What are you exposed to? And the one thing about like buy and hold, Warren Buffett's big rule is buy it and hold it forever, and you'll make yourself a lot of money. doesn't subscribe to his own rule today of buy and hold. Mutual funds, they're kind of captured. So if you bought a blue chip growth fund and it's a portfolio of all blue chip stocks, Coca-Cola, IBM, AT&T, blue chip stocks. So this portfolio is all blue chip stocks. But if the money manager knew the stock market was going to correct, he has to be invested in blue chip stocks. So he can only go to cash maybe up to 15% of the portfolio. I don't like those type of funds. Very restrictive. I like funds like ETFs that could go 100% cash, 100% invested. It's a little bit more protection. Not day trading. I don't want it on a daily trade, but I definitely want it over time. I want to be able to save when the market zags. So we can introduce you to things like that. Right? Yes. Two answers.
401k is based on stock market.
Well, a 401k is a company-sponsored plan, and they give you about 35 different mutual funds to choose from. They usually don't give you too much advice, but you could have a blue chip mutual fund, you could have a target mutual fund, you could have a bond mutual fund, so you have options on how much exposure of risk that you're willing to accept. They have a money market one. It's not going to pay you much interest rate, but they'll give you the list of funds.
Now, can a self-employed have 401k?
Well, a self-employed could start their own 401k, but they'd probably be better with a SEP, self-employed pension plan, or a IRA. So there, for someone self-employed, there are options. Definitely options. But remember to have your emergency bucket, your life insurance, and all that other stuff. Your Roth already.
Listening to you, I'm not so bad.
All right, good. Any other questions before we wrap it up?
Just real quick, because you just told it self-employed pension, so if,
A SEP. You heard the word SEP?
never heard it.
Oh, okay.
It's pretty cool. I've never heard that. My husband is self-employed. I have pretty much everything else that you mentioned, you know, for
Good.
UPS for years. But the IRA, he's never done, and he could put 6,000, as you said, every year.
If he's under 50, yes.
He's 47.
So he turns over 50, he gets a, no, after 50, he gets a bump up, he gets to $7,000 a year.
And then whatever gains happen, they didn't happen, they're his.
There is, yeah.
Okay,
Tax-free.
okay,
We love tax-free.
yeah.
So that would be an option for a self-employed
Yeah, that's an option.
like me.
Yeah. Definitely an option.
Yeah, because you said you're leaving money on the table with a 401k that's been matched, so it's the same thing, you're leaving money on the table if you're not taxed.
Yeah, if they're not matching anymore, you're up to the match, then I would, again, you want your emergency bucket, life insurance, and 401k, you want to get 100% up to what the company's matching. If the company's not matching, I would substitute the Roth IRA contribution first to get that tax-free money. All right. I really thank you guys for coming out. I hope you enjoyed it. I hope you got something of it. I'm an open book. If you see us, we are on social media. But if you want to get on our mailing list, again, you can subscribe, unsubscribe at any time. But I don't want to bombard your mailbox. But 2 times a week, we do put market news out. One of them from our one of the main money managers we use. It has a byline, and we'll introduce you to that because I think that's very intriguing and it's done extremely well. Viv, anything else? Stephanie, anything else? All right, that's it. Thank you. No testing. Thank you.